Welcome back, everyone, and thank you for your attention. We're going to go ahead and get started again. My name is Kevin Smith, and I'm one of the faculty here at Stanford. I'll be moderating this section, and just before we begin, I want to thank Stefan Huber, who is going to be behind the scenes helping me to curate the questions. Stefan is one of our exceptional PhD students who is on the job market this year. And with that said, I want to welcome Dan Taylor to present his paper, Voluntary Disclosure When Private Information and Proprietary Costs Are Jointly Determined. The floor is yours, Dan.
Everybody see the slide deck? Give me a thumbs up if you can see the slide deck. All right. Okay, so Stefan, thanks for taking care of the questions for me. Only theory questions, no empirical questions for this paper now. Okay, so this paper is joint with Jungmin Kim, who is a rising fourth-year PhD student at Wharton. She has one more year in the program, and then she'll be out of the market. Myself, and then Robert Verrecchia. So what are we doing in this paper? So here I think it's really important to scroll back and to think about sort of this massive empirical literature in accounting that looks at voluntary disclosure and really why we don't gravitate to a corner solution of everybody voluntary discloses or full disclosure, or a solution of no one discloses. So you would think that it would be relatively straightforward, but there's really surprisingly mixed empirical evidence on the theory. I tried to figure out a way to illustrate this succinctly, and I found this quote from Phil Berger, which I think basically illustrates the issue succinctly. Even widely accepted results, like when proprietary costs go up, disclosure goes down, it's really actually hard to find evidence of that in the data. And we're still drawing on the same theories. We're still drawing on Dai-Jung Kwan. We're still drawing on, Verrecchia 83, Verrecchia 90, and, we're 30 years hence. And so we still haven't really, nailed things down. So let's dive into the literature and take a step back and think about why the mixed results, might be pervasive. And so I'm going to give a little warning here. I'm the evening's entertainment, so we're going to need some healthy introspection. All right. Okay, so let's think about what a traditional empirical voluntary disclosure paper looks like. Certainly many of my papers. So I'm going to basically go through the formula for writing a voluntary disclosure paper. I followed this formula, so no one's being impugned here. So basically, step one is you find a setting. It's interesting to study where it's interesting to study voluntary disclosure. Maybe there's a regulatory change. Maybe you've got some new data. Step two is you try and ground your setting and your predictions in theory. So map your empirical setting back to some theory constructs. And if you look at the voluntary disclosure literature, you can pretty much put all empirical papers into one of four buckets. And this ties back to the fundamental economic forces that are in the theory models in Dai-Jung Kwan and in Verrecchia. It's disclosure costs, okay, so that's often proprietary costs. Public information, so the quality of mandatory disclosure or intermediaries like analysts. Private information, what does the manager know, or what do sophisticated investors know? And then agency friction, so like Jensen and Meckling and those sorts of arguments. So everything sort of goes, you got your setting, pick one of those four as your frictions to motivate a prediction. Then once you got your theory and you've got your setting, then you motivate the prediction. It's typically ceteris paribus based on those theory models. It's typically monotone. So we often see something like, setting X reduces proprietary cost of disclosure. So we predict X is associated with greater disclosure. Or we often see papers that pit countervailing forces against each other. So we see something that basically says, on the one hand, setting X could be associated with, say, greater proprietary costs, leading to negative association with disclosure. On the other hand, it could entail, say, lower public information, and that would be positively associated with disclosure. Ultimately, it's an empirical question which of these two countervailing forces win out in the data. Right, and so what's the next step? So we've got our setting, we've got our theory motivation, we've got our empirical predictions. Well, the next step is to test which one of those forces wins out. So you test the prediction linearly, you regress the measure of voluntary disclosure on X, whatever your X variable happens to be. And if it's positive, it's great. Maybe that's what you predicted. If it's negative, maybe you go back, you pick one of the other multiple choice variables, switch from proprietary cost to public information or something else. But what if beta is equal to 0? What happens then? Like, what do you do here? Well, the abandonment option. You hit the eject button and you bail out of the project because you're testing things linearly. That's kind of what you need to keep going. So given that you can't find, if you estimate linear regression and you find 0 coefficient, you may abandon the project, unfortunately. That's kind of where we're at in the state of the voluntary literature is at. And so I've tried to wrap that in the philosophy of science chart that I've got here, unexplored setting, relate to voluntary disclosure, one of 4 fundamental theories, make a prediction, positive or negative, estimate linear regression, no linear regression, move on, come up with a different measure. So let's think about what we're going to do in this paper. All right, so that's the background. So our motivation here is mixed empirical results despite compelling theory, right? The theory is compelling. People, often say like, oh, well, it's not surprising that, higher taxes lead to lower earnings or something like this, And my response is, yeah, and it's not surprising that when disclosure costs go up, disclosure goes down. You'd think it's very, very compelling, but we really can't find evidence of it. So one of the key assumptions there is that the economic forces are independent, that empirical researchers have been able to isolate the individual theoretical constructs and control for all of the other forces. So we can precisely measure proprietary costs and control for it, or we can precisely measure managers' private information and control for that. But we're really questioning that in this paper, whether we can do it. So our approach is to say, well, maybe private information and disclosure costs go hand in hand. So you could think about a setting where the disclosure costs are proprietary, something like this, and then tell a story where if the manager has better private information, that better private information is going to convey a larger advantage to competitors. And so that would make it potentially more costly. So our prediction, when those two things go hand in hand, is an inverse U-shape, something that we call unimodal. We test the prediction, so we test the shape of the relation. And then we're going to triangulate. So I'll show you that the U-shaped relation holds up in multiple settings and using multiple designs. So what do I want the takeaway to be? The takeaway here is not specific to the empirical settings that we test. I don't want that to be the takeaway. I want the takeaway to be more of like it's a stealth methodological paper. All right. So the first takeaway is presence of 2 countervailing forces, rather than say, oh, well, one goes positive, the other goes negative. It's an empirical question, which one it is. Let me test for the dominant force. Well, the presence of 2 countervailing forces we show it can generate an inverse U-shape. So it's not always going to be the case that one of those forces are dominate. If both forces don't dominate, you may very well get an inverse U-shape. That inverse U-shape, if both forces are present in a variety of settings, will generate an inverse U, and that can potentially explain why much of the prior empirical literature, which is premised on linear regressions, finds mixed evidence, because they're not actually estimating the shape of the relation in the data. Instead, they're trying to fit a line to what is ostensibly, we're going to claim, a curve. So takeaway, if you estimate the linear regression and you don't find anything, do not give up hope. Try and see if you can come up with, think more richly, think about, is it proprietary cost? Is it disclosure, proprietary cost, private information, public information? Are there 2 forces here that are moving simultaneously that could potentially give me something other than a linear prediction? All right. So that's kind of the high level overview of the approach that we're going to take. Now, specifically in terms of the theory, we're just going to mash together Dai-Jung-Kwan and Verrecchia models. Okay, so we're going to have a probability of private information. That's this adverse selection. And we're going to have disclosure costs down here. So rather than separate them like the old theory papers from the 80s do, we're going to combine them into one model. Here's where things kind of get interesting, right? Because we've seen theory papers before. Everybody, I think, has seen a theory paper, knows how they're typically written. We've seen empirical papers. Now we're going to try and smash it together. We're going to suppose that there's an empirical proxy, X. The model's not going to tell you what X is, but it's going to say, suppose there's an empirical proxy X that's positively associated with both private information, which you can observe, and disclosure costs or proprietary costs, which you also can't observe. What would the fundamental relation be between the empirical proxy and the voluntary disclosure? Now, I should also caveat, I have disclosure costs here on the slide. The model is silent on where the disclosure costs come from. It could be proprietary costs, could be auditing costs. The model is also silent on where the private information comes from. Could be something that the manager sort of acquired, several years back. Could be as a result of a new project. Could be exogenously, come from some other source. So we're not talking about where these variables come from, other than that they are related to X. X is a driver of both of these variables. So then the question is, well, if X is a driver of both of these variables, what's the relation to voluntary disclosure? Well, that's basically what the relation is. It's unimodal. There's going to be a unique peak here. It's going to be increasing positive relation on the left side, negative relation on the right side. So that's really what we're going to be looking for in the data. Now, the tricky thing is that we're going to identify this shape. Okay, so we've got a specific shape in mind. That gives us some advantages because an alternative explanation has got to predict a theory-based explanation has got to predict the specific shape, but it's not clear that we'll have sufficient sampling power, right? So this isn't going to work with a natural experiment where you've got sort of like a binary treatment variable, because to generate the inverse U-shape, we have to observe firms on the left side of the distribution, on the middle side of the distribution, and on the right side of the distribution. If we only picked firms on the right side of the distribution, then we would see a negative slope. And similarly, on the left side, only a positive slope. So we got to get massive cross-sectional variation. So you can think about this as picking up firm characteristics. Okay, our setting. Our first setting, capital investments. Why are capital investments associated with private information? Tesla is a great example. This gigafactory, they're trying to make the planet green, install solar panels, drive these batteries for their electric cars. Super secret, super secret. So prior literature says capital investments, higher private information, higher proprietary cost of disclosure. Next setting, again, prior literature. I'm just running through this pretty quick because I see my time is escaping from me. Major customers. These are the settings that prior literature uses because we're trying to show that in prior literature, you have this inverse U-shape and trying to reconcile those mixed results. So we're not the first one to look at these settings. We're citing prior work for those. So we look at the data. What does the data show? Raw univariates, industry year adjusted, inverse U-shape, polynomial regressions, so squared terms negative for CapEx, inverse U-shape, spline regression. So we're estimating separate slope coefficients on either side of the kink, which is tau. And we also find positive on the left side and negative on the right side for CapEx. And we're going to find the same thing basically for major customers. So we've got two settings. We've got CapEx, we've got major customers. We find evidence consistent with this inverse U-shape. We've got multiple measures of voluntary disclosure, management forecast, CapEx forecast, sales forecast, product market forecast. And so the summary here is that there is in fact this pervasive inverse U or unimodal relation in the data. And I hope that this is not both the first and the last paper on this inverse U, because I actually think it's quite pervasive. Takeaway: if you don't find a linear relation when you're looking at the data, think about whether you can combine two of those four economic forces rather than just picking on one to come up with an inverse U. Finally, I'm going to touch on this, and this will lead into Iván's discussion. I want to caveat, it's motivational only theory. We are not breaking any new theory barriers here. we tried to use as little theory as necessary to capture the forces, and we're not taking things literally. Why do we have theory? Well, I couldn't intuit an inverse U, but so I do think the theory here is really important. Thank you very much.
Thank you very much to the organizers for the opportunity to discuss this paper, in particular Maureen and Patty. Thank you also, Dan, and the authors for the paper. I enjoyed reading the paper and thinking about these issues. I learned a lot. So what's the main question here? I think this graph, this plot, captures the main puzzle this paper is trying to explain, which is this robust nonlinear relationship between disclosure, voluntary disclosure in particular, and measures of incentive, such as CapEx, right? So this is the core of the paper. And I think one can summarize the contribution with these 3 bullet points. First, the paper provides really robust evidence of this nonlinear relationship. But more importantly, it provides a theoretical explanation for this nonlinear relationship. And here I'm biased because I think that theory is often very useful to understand the world. And in some cases, it's actually indispensable. So I really appreciate that aspect of this paper. And I think they use theory in a creative way to explain something that I would not have been able to explain just based on intuition. So in that sense, I totally agree with that. And so this is also important empirically because it reconciles mixed results in the literature, right? So what I'll try to do is to unpack the result, to give you the ingredients and to understand the scope of the results. So first, let me just briefly summarize the theory they are using. They're relying on 2 well-known theories. The first one is Dye in 1985, which is known as the uncertain information endowment. We don't know whether the manager has information. In particular, if the market thinks the manager has information with probability Q less than 1, then some firms, or with some frequency, the firms will conceal information, in particularly negative information, because firms can sort of pool with those firms that do not receive information and avoid triggering very negative market reactions, right? So the main prediction of the Dye theory, at least from the perspective of this paper, is that the probability that the firm will disclose this information will be increasing, monotonically increasing in Q, in the probability that the manager gets information, in fact. So the prediction is a monotonic relation. The second important theory is Verrecchia 83, Verrecchia 90. So this theory posits that firms face costly voluntary disclosure. There are proprietary costs that affect their disclosure decisions. So if the firm faces a disclosure cost C, then again, a fraction of firms will fail to reveal their information. In particular, they will hide the most negative information. But again, this theory predicts that we will have a monotonic relationship between disclosure and the proprietary costs of disclosure, right? So here's the puzzle. Both standalone theories predict a monotonic relationship between disclosure and incentives. And here is where I think KTV help us understand sort of the world by combining both frictions, which are likely to be present in the real world, right? So both frictions are likely to be present. We can combine them and see if by putting them together, we can explain the nonlinear puzzle. The problem is that we don't observe the frictions. We don't observe Q or Z. However, we have proxies of them. So what KTV assume is that both Q and C are monotonically increasing in CapEx, and this has antecedents in the literature. People have made this assumption and have documented the relationship before, and it's also very intuitive. Managers undertaking capital-intensive projects are likely to have private information. At the same time, it may be more costly to disclose information in those cases, because it would reveal proprietary information to competitors, right? So this is the setting, and these are the assumptions they make to see if by doing these assumptions, by making these assumptions, we can explain the basel. And so what they show us is that under some technical conditions on the mapping between Q and CAPEX and C and CAPEX, the probability of disclosure is going to be hump-shaped in CAPEX. And so what's going on here is that as we increase X, namely CAPEX, essentially two things are happening, right? On the one hand, the manager is receiving more information, or with a higher probability. On the other hand, disclosure is becoming more costly, right? So at low levels, at the left of the distribution, the die friction dominates, and we have an increasing relationship. At high levels of X, at high levels of CAPEX, the Rekia world, or the Rekia friction dominates, and so we have sort of the Rekia world, right? So this is very nice, because by putting together these two natural frictions, we are able to explain a feature of the world. So let me just give you briefly the agenda. What I'm going to try to do is to unpack this result, try to understand whether we need two frictions, whether the two frictions are sufficient. I'll say something about falsification, then I'll talk a little bit about what drives the nonlinearity, and finally I'll do a little toy structure exercise to quantify the frictions. I don't know how much time I have, but let's try to see, let's try to fit everything in the remaining time. So are the two frictions necessary? So here, the point I want to make is that there are two ways we can explain the nonlinearity. One is, as KTV are doing, by assuming that there are multiple countervailing forces. The alternative is that we only have one force, but that force exerts a nonlinear relationship, right? So for example, we could assume that C is equal to 0, but the relationship between Q and CAPEX divided by PPE, which I think is the empirical proxy, is non-monadonic, right? So it would appear that the second approach is simpler, because we don't need to assume two frictions, we just assume one. But on the other hand, it's not very natural. It's not clear to me at least why would there be a nonlinear relationship between CAPEX and let's say the cost of disclosure, or the probability the manager is informed. So I think if I had to vote, I go with KTV here. The second question one may have is whether the two frictions are sufficient to explain the hump shape. And my answer, or the answer, is that the presence of these two frictions is not sufficient. In other words, I can choose other functional forms for C as a function of CAPEX that would yield the opposite shape. For example, if the cost of disclosure were increasing but bounded from above, instead of a hump shape, you would get an inverse U shape. You can get linear shapes, you can get any shape you want. Now, that's not per se a problem, right? When we test the theory, we are not ruling out, alternative theories. However, I thought this would be useful, so you understand what you are buying when you buy KTV theory. You're on the one hand buying the notion that the two frictions are present, along with some auxiliary assumptions about these cost functions. Okay. Another concern that related to what I just pointed out is that this model seems to be hard to falsify, because if you can come up with reasonable assumptions for C or Q that would fit any shape that we observe in practice, then this model is essentially unfalsifiable, or at least the test would be unfalsifiable, right? So, I thought about what type of evidence do we need to falsify this model, and perhaps the best one that comes to my mind is a prediction that is very key to disclosure models, which is the notion that firms will tend to conceal bad news. In other words, disclosures, management forecasts, for example, will be truncated from below. And that would imply that if you look at forecast errors, the distribution of forecast errors should not be symmetric around 0, but should display positive skewness. My claim is that if the data rejected this prediction, then the model would not be a good explanation. If you look at the distribution, so here is an histogram of forecast errors using Dan's data. It's not easy to see the positive skewness, right? It looks actually pretty symmetric around 0. However, if you really run a test, a formal test of skewness, you do find the positive skewness, right? Skewness is significantly different from 0. And this is actually consistent with strategic disclosure. I think it's very reassuring. And I think maybe it would be useful to add this test to reassure the reader that we are facing a strategic disclosure in the empirical setting they are discussing. But KTD do not really look at truncation. They focus on fitting a second-order polynomial, and they show that it really looks like the hump shape I showed you before. This is what the data shows you. However, if we think about what is driving this nonlinearity, I think it was useful to look a bit more deeply about the relationship. And I did myself a sort of non-parametric estimation between forecast and CapEx, controlling for pharma French industries and year. And surprisingly, you do find something that really looks like a parabola, right? It's not exactly a parabola, but something that's quite close to it. So that is, again, very reassuring. However, if you do the same, but instead of CapEx, you use size, you kind of get the same, right? So I was a little bit intrigued by that. In fact, if you look at the goodness of fit, not a great measure when you're estimating something nonlinear, but if you look at the goodness of fit, size actually does much better than CapEx. So I don't know whether that's something to be worried about, but I wanted to point it out. And moreover, if instead of size you use year, which is just completely random, right, or industry, can you get sort of a similar nonlinearity? And here I'm totally puzzled. Why would that be the case? Maybe you have a good explanation. Maybe the explanation is noise. I wonder whether these concavities or these inverse U shapes have something to do with some excessive noise at the tail. So the institution have no idea, but it's something that I think would be worth discussing. Now, why not structural? So the paper is finding evidence that is consistent with 2 frictions. So I think it would be interesting to quantify these 2 frictions and understand which one is more relevant. And to do so, I propose a very small model trick designed that can be structurally estimated with the data they have. Essentially, I assume that the cost function is a linear function of CapEx, X, right? And the probability of informedness is the probability the manager gets information is given by this function here. So there are essentially 2 parameters I want to estimate. If you solve them all, you arrive at an equation that gives you the threshold tau, above which the manager will choose to disclose and below which he will conceal. Now, this mole, or one of the main predictions of this mole, is the probability of disclosure, which is going to be a function of CapEx, and the 2 parameters that you want to estimate. So what you can do is to essentially match the empirical frequency of disclosure to the prediction of the mole to get the 2 main parameters, and then try to think about what these parameters imply, for example, in terms of the cost of disclosure. I find that is 39% of the standard deviation of firm value, which is too large. Maybe this is not a good sign, perhaps, you would say. But on the other hand, I find that the probability that the manager is informed is pretty reasonable. It's 92% in a management forecast setting. That sounds very reasonable to me. You can also think about some counterfactuals. So think, for example, about the probability or the frequency that the manager hides information strategically when it's bad news. That comes out to be 28% in the mole. And then you can also think about counterfactuals like what would happen if the manager was always informed with probability 1. Then what this mole would predict is that the probability of disclosure would be 97% instead of 63. Whereas in Dye's world, where there are no disclosure costs, the probability of disclosure would be 78%. So from these counterfactuals, it seems like the Dye 98 friction is actually the main factor explaining those disclosures. So just to conclude, I think this paper combines theory in a creative way to rationalize an empirical fact. I have some other comments that probably run out of time. So I'm happy to talk offline with Dan about these points. But again, thank you very much for the opportunity, and thank you, Dan, for writing a nice paper that gave me a lot of food for thought.
Dan, if you'd like to take a minute to respond to any of the points in the discussion, please feel free. Otherwise, I can lead right into the questions.
Not really respond so much as, Iván, when you asked for the data for the paper and you said you were going to test an implication of our model that we didn't test and then share it with the RAST conference, we were kind of pretty nervous. So I'm glad that the skewness test worked out in our favor.
All right. So there's several questions related to the functional forms in the paper. Specifically, Xu from Duke argues that the model really can't rule out, or does not rule out, the possibility of other patterns in the data, such as multimodal patterns, if you have different functional forms. And it's also curious, based on this, whether your goal is to theoretically explain the mixed empirical evidence, which isn't necessarily just a unimodal shape, or is it specifically to explain why you're finding this unimodal shape in this setting?
So that's a great question. I mean, I think, and this goes back to a point that Iván made, is that, we have a cost function, we have a function for the private information. And those functions, you could put in, whatever you wanted into those functions, and that would generate, various shapes for the voluntary disclosure function. What we did in the paper was we tried to keep the functions general and say, what conditions do we need over these functions to generate unimodality? And it turns out that there are a wide class of functions. Linear, for one. So if the cost is linear in X in the empirical variable, the private information is linear in the empirical variable, the rabbit out of the hat is you got two linear frictions, but somehow you get this, this nonlinear inverse U shape. So yeah, I take the point that you can, pick a different cost function and pick a different probability of private information function and get a different shape. I think this is where I would say the synergy of empirics and data is that the two are, forgive the pun, the two are sort of tailor-made to come together, in the sense that we peeked at the data when designing the theory, and we peeked at the theory when doing our tests. So there was an iterative process. So I take the point that the theory doesn't rule out other shapes for different cost functions.
Okay, next question is from Edwige at Washington University, St. Louis. She's asking whether you've thought at all about controlling for management incentives to disclose their incentives to maximize short-term stock price, and whether you've actually checked in the data whether, in fact, it is the case that managers appear to have the goal of maximizing their short-term price.
We don't do any, I think some literature or some papers try and control for sort of what they call it short-termism for managers or myopia. I don't think that we put in any empirical controls for manager myopia. It is true that the model assumes that the manager is maximizing firm value minus the cost of disclosure. And I haven't verified, and I'm not sure how I could verify in the data that in fact the manager was trying to maximize the value. But to the short-termism price, we haven't. That's something that we can consider somehow controlling for, but we haven't looked at short-termism.
Okay, next question is from Stephen at UNC. And he's asking whether, if you have a setting where it really appears that you have a clean measure of proprietary costs, that it is potentially independent of the manager's private information endowment. In this sort of setting, is it actually feasible that you would expect a measure like this that clearly increases the cost to do anything other than decrease the level of disclosure? And following up on that, he's curious whether the literature on proprietary costs should move from do proprietary costs discourage disclosure to does a specific variable actually impose proprietary costs on the firm in the first place?
Yeah, Matt, I think that's a good question. So let's assume for the moment that we have our theoretical construct, manager's private information, and our theoretical construct, proprietary costs. And we can measure those perfectly. There's no error. Then if I stuck those in a linear regression, I would get consistent signs. because when I test for the relation between private information, voluntary disclosure, I'm gonna get a positive relation because I'm controlling for proprietary costs perfectly. And I'm gonna get a negative relation on proprietary costs because I'm controlling for managers' private information perfectly. So in a perfect world where we can observe and control for everything perfectly, I agree with Stephen, disclosure costs are always going to reduce disclosure. They reduce disclosure in the model. What we're saying is that you're not going to find such a setting. I haven't found, maybe I'm not precluding such a setting from existing, but in a world where you can't perfectly observe it, then you can't perfectly control for all four of those forces. So then, what would be the prediction in a world in which those two things are changing simultaneously? But I certainly, Stephen's right. If it's perfect measurement in a perfect world, then it's unidirectional, no unimodality.
Okay, next question is from Judson at UCLA. And he's asking, first of all, whether management forecasts are an appropriate setting for testing a model where there's an uncertain information endowment, since it seems likely that the manager basically always has information regarding the company's sales and profits, and also whether it's legitimate to assume in the forecast setting that the proprietary cost C is in fact significant, since finding out earnings a week early can't really cause that much damage to the firm.
Well, that's a great question, Judson. I'm going to take the opportunity to use that to plug one of my other papers with Mirko and Frank and Chung Ho. And the answer is yes, it can impose proprietary costs because of stickiness in the voluntary disclosure decision. So even though, let's say I'm making a decision to provide a forecast 2 weeks before the earnings announcement, what we show in our paper, and it's a joint theory empirical paper as well, is that quasi commits the manager to continue to provide forecasts every quarter going forward over a sequence of, let's say, T periods. The manager takes that into account, recognizes he can't provide a forecast this period and then not provide one next period. And so he takes future performance many years into the future in account when deciding whether to issue a forecast in the current quarter, even though there's only 2 weeks until that quarter's earnings announcement. If you're interested in that, it's on SSRN. You can look it up. I don't want to get sidetracked too much. But yes, even though there's only 2 weeks left in the quarter, the management forecast can still entail proprietary costs.
Okay, next question is from Stefan at the University of Melbourne. His question is, he's concerned about the causal connection between something like investment and disclosure, since investment decisions and disclosure decisions are made jointly by managers based on private information.
Yes, great question. I mean, I think really that there are, I think there's multiple approaches to thinking about how to do empirical work. We did not do a sort of what I would consider like an average treatment model, where a diff and diff, where we had exogenous variation in PPE or exogenous variation in CapEx. And I'm actually very skeptical that such an empirical approach would be conducive to testing an inverse U-shape, because when you're estimating a diff and diff or an average treatment effect, you're implicitly conditioning on where you are in the distribution. So for example, if you think about that hump shape, if I'm in the left tail and I estimate an average treatment effect from a shock to investment, say, that's going to move me, it's going to increase voluntary disclosure. It's going to move me to the right, closer to the peak. But if I'm on the right tail and I have an increase in investment, that's going to move me further to the right, away from the peak. That's going to decrease voluntary disclosure. So, I will completely own up to the fact that we've hand waved, the empirics and punted on causality. Instead, what we've tried to do is we've got this theory that predicts a shape in the data, and then we look to the data and see if that shape manifests. And in fact, I think CapEx is really a firm level characteristic in our setting. I don't think you're seeing, massive shifts in CapEx from one year to the other. So that's a very different approach, I think, than some contemporary work. If you're curious about that approach, check out Heckman and Singer, Abducting Economics. It's in AER, about how to use theory and empirical work together to draw causal inferences, even in the absence of exogenous shocks.
Okay, next question, I hope I get this right. It's by Sudipta at Temple. He's asking, whether if you have nonlinear functions, is it very likely that interactions of variables, even if perfectly measured, will be significant unless they're all uncorrelated to start with?
Can you say that again?
Okay. If functions are nonlinear, then it's quite likely that the interactions of perfectly measured variables will be significant unless they're uncorrelated to start with.
So I'm gonna have to punt on that one. We can take that
Okay.
offline. That's my head hurts from thinking through that, to be honest with you. I don't think that's necessarily true, but I need to think more about it.
Okay, so that's it for the questions.
Oh.
I have a couple of my own, actually.
Well, I can take
given that we have this extra time. So the first thing I'm curious about is, the model is ultimately a setting where you have one firm that has a fixed set of parameters. We know in the data, we have tons of different firms with different parameters. So while the model predicts a U shape for any specific firm, the point where you get a minimum for each firm is ultimately going to depend on what those other parameters are. And so when you start looking at a cross section where you have different firms that potentially have different U shapes with different minima, it's not so clear to me that the model would predict in these cross-sectional regressions that you would find a U shape or not. Of course, I think controlling for these variables could definitely help there, but it's not clear that the model predicts that there's a linear relationship between whatever these parameters are and where you'll find that minimum. So it's not clear to me that just linear controls are going to fully correct for that sort of effect.
Yeah, so I will say, great point. I will say that because we're testing polynomial, we also include polynomials on the controls. So for example, Iván was saying, hey, you get this result with its size squared. I'm not sure whether we would predict that or not, because I could probably tell a story where size is measuring proprietary. I mean, size measures everything, depending on who you ask. But we've got size squared as a control. So we are trying to control away for a lot of the other, potential things going on there. The other point that you made is I had always thought about the U being cross-sectional. So I didn't think about a given firm changing its location in a U over time. I thought about the model as applying to a snapshot of the economy in a given year. So some firms have lower private information, others have higher private information, sometimes have lower proprietary costs, others have higher proprietary costs, as opposed to a given firm having this U-shaped relation, because I don't think a given firm has sufficient variation over time in proprietary costs or in private information to generate its own U-shape. So in that sense, I think CapEx and the customer satisfaction is really picking up a cross-sectional variable. It's not picking up like temporal. And to that point, we didn't include firm fixed effects. So an interesting question, when are firm fixed effects inappropriate? Well, they're inappropriate when you think that your variable of interest or your hypothesis is cross-sectional as opposed to temporal.
Okay, just one more for you. So it seems like in the model, there's obviously a bunch of parameters other than just the proprietary cost and the probability of the manager's disclosing, for instance. The one that stands out to me is just overall investor uncertainty. So it seems like you could also write a model where additional variables might depend upon whatever the empirical construct is. And it seems reasonable that investor uncertainty would also vary with something like CapEx or major customers. Of course, you could probably also generate various nonlinearities using other variables, but I'm just wondering how you think about choosing two specific variables.
So I actually think, like, if you were going to ask me how I would push this work forward, that's how I would push it forward, by choosing two variables. I think that the choice, it sounds kind of silly, but it's like the literature has exhausted the single variable, one variable at a time, found mixed evidence. So now I'm kind of advocating to two variables two theoretical constructs at a time. But when you think about it, like the coronavirus would be a good example. The coronavirus increased investor uncertainty. And it also increased manager uncertainty. Now you have two variables. So you wouldn't want to necessarily predict the relation between the coronavirus and voluntary disclosure just using investor uncertainty, because manager's uncertainty changes as well. So that, I think, is sort of something to think about in terms of, when we have an empirical setting, there's probably more than just one of these variables going on. So that's one way to push forward.
Makes a lot of sense. Well, thanks so much for the presentation. It's a very interesting paper. And with that, that concludes the day one of the conference for us.